FOMC, interest rates, and the future of crypto. Hello, friends. Welcome to Mr. Suw Crypto, a relaxed yet insightful podcast that always invites you to explore the world of crypto from an unconventional angle. In this episode, we'll discuss something that might sound technical, but its impact directly affects all of our wallets. Yup, we're talking about the FOMC, interest rates, and why the crypto market can suddenly become volatile just because of one announcement from Washington, D.C. Yesterday, the Fed, the U.S. central bank, announced an important decision regarding interest rates. And the result? Many said, no changes. But hold on. Behind that decision lies a crucial signal about the direction of the global economy, including whether crypto will soar or slowly deflate. Now, before you think this is just about the U.S. dollar, trust me. If you hold Bitcoin, altcoins, or even just DCA every month, you need to know what the FOMC is and why every word from Jerome Powell can send the market into a tailspin. In this episode, we'll discuss 4 key points. First, what is the FOMC and why do traders worldwide pay attention to their meetings? Second, how can FOMC decisions impact global markets and, specifically, the crypto market? Third, we'll break down this morning's FOMC decision, why they held interest rates steady, and the reasoning behind it. And finally, what strategies can we implement in such conditions to stay afloat and profit in the crypto market? So, grab your headphones, brew your coffee, and let's discuss together, from macroeconomics to long-term strategies. Disclaimer: everything discussed in this podcast is for educational purposes only. It is not a recommendation to buy, sell, or hold specific assets. Crypto is a high-risk asset. Always tailor your decisions to your own risk profile and don't forget to do your own research. Chapter 1. What exactly is the FOMC? And why should crypto traders care? Alright, before we dive deeper into the newly announced FOMC results, we need to clarify. What is the FOMC? For some people, FOMC is just an acronym that makes them furrow their brows. But trust me, if you understand how the FOMC works, you'll gain a key insight into market direction, especially if you're a self-proclaimed crypto degens. Here's the deal. FOMC stands for Federal Open Market Committee. It's part of the Federal Reserve, aka the Central Bank of the United States. The FOMC's job is no joke. They're the ones who set U.S. monetary policy, including the much-anticipated benchmark interest rate. The FOMC holds scheduled meetings 8 times a year. But sometimes there can also be emergency meetings if the global situation is unstable. Every time they meet, the entire world watches the results closely. From bankers, hedge funds, stock market participants, to crypto traders in internet cafes or under mango trees. Everyone is on edge. Why? Because their decisions can be a turning point for the market. Raise interest rates? The US dollar could strengthen, stock markets could fall, and crypto could plummet. Lower interest rates? The market could go into euphoria. Even without any interest rate changes, if Jerome Powell's body language shifts slightly, the market could flip upside down. Seriously, the FOMC announcement is often referred to as the global economic theater stage due to its immense influence. And Jerome Powell? He's like the main actor. Once he says, "We're still looking at the data," analysts immediately create 30 PowerPoint slides. If he coughs during a press conference, it could trend on Twitter. But why does crypto care so much about the FOMC? Isn't this just the central bank's business? Well, that's where the misunderstanding lies. Crypto may have been born as an alternative to the traditional financial system, but the reality is, crypto still can't escape the grip of global liquidity. This means that if the Fed tightens liquidity by raising interest rates, money becomes more expensive. Investors will pull funds out of risky assets, including tech stocks and, of course, crypto. Conversely, if interest rates are lowered or there are signs of easing, money flows everywhere. And typically, crypto gets a significant share because it's seen as having higher potential returns, though the risks are also more severe. So, whether you hold Bitcoin, altcoins, or are staking in DeFi, you can't ignore the FOMC. This isn't just about the U.S. economy. It's about the pulse of the global financial system. And FYI, the FOMC's decisions aren't just about interest rates. They also manage something called quantitative tightening, QT, or balance sheet normalization. Essentially, they can control how much money circulates in the global system. Again, this directly impacts crypto liquidity. That's why every time the FOMC issues a statement, traders read every line carefully, like decoding a secret code. Sometimes, just one word changing from modest to gradual can shake the market. This is called forward guidance, subtle hints about the direction of future policy. Conclusion for those new to crypto. Don't just follow the BTC/USDT chart every day. Take the time to understand the FOMC calendar. Because if you trade or invest without understanding the macro context, it's like playing soccer without knowing where the goal is. Chapter 2. The impact of the FOMC on global markets and crypto trading. Now that we know what the FOMC is and how important its role is, let's discuss its real-world effects. I mean, not just for traders on Wall Street, but also for us who are staring at charts while drinking instant coffee at 2 a.m. Here's the thing. Every FOMC decision, whether it's raising, lowering, or keeping interest rates steady, has an immediate impact across various layers of the financial market. From exchange rates, stocks, bonds, to, of course, crypto. And it's important to note, sometimes it's not the FOMC's decision that causes market volatility, but the market's expectations of what the FOMC will do. Impact on global markets. As soon as Jerome Powell speaks, global stock markets perk up. Technology stocks on the Nasdaq can rise or fall in less than a minute, depending on whether the market perceives dovish, easing, or hawkish, tightening, signals from the Fed chair. Why is that? Because interest rates are like the base price of money. If interest rates are high, money becomes expensive, borrowing costs rise, companies reduce expansion, revenue declines, stock prices fall. And vice versa. If interest rates are low, money is easily accessible, people consume and invest, the economy picks up, asset prices rise. That's why FOMC decisions can directly move indices like the S&P 500, Dow Jones, and even oil and gold prices. What about the US dollar? Typically, when the Fed raises interest rates or signals it will remain tight, the dollar tends to strengthen. This is because returns on dollar-denominated assets become more attractive. But if interest rates are held steady or signals of easing emerge, the dollar can weaken as investors seek higher yields elsewhere. So, what's the impact on crypto? This is where things get even more interesting. Crypto is often referred to as a high-risk asset with the potential for super high returns. What does that mean? It means it dances to the rhythm of liquidity. When the Fed began aggressively raising interest rates in 2022, Bitcoin and altcoins plummeted. Global liquidity tightened, and investors became more cautious. BTC, once hailed as digital gold, lost its luster because it couldn't compete with the 5% return on US Treasuries. Especially if you held microcap altcoins, they might just be left as logos on your watch list. But the story changes when the Fed starts signaling easing, or even just a pause in interest rates like now. The market immediately interprets this as an opportunity, indicating that liquidity pressures are easing. Crypto, as the wild child of the financial world, moves first, sometimes even faster than stocks. Real-world example. Following last night's FOMC announcement maintaining interest rates as expected, some coins saw a slight rebound. Bitcoin remained stable above $104,000. Ethereum rose to around $2,499. Altcoins are also starting to peak at breakouts. And this is interesting because even though the increase isn't significant, it could be an early signal that the crypto market is starting to take risks again, especially if dovish signals become stronger in the future. But don't get too excited just yet, because crypto remains vulnerable to macroeconomic uncertainty, especially if Powell changes his tone or a new geopolitical conflict suddenly emerges. Prices could reverse direction overnight. FOMC and crypto market psychology. What's fascinating about the crypto market is that here, we can see market psychology in its wildest form. FOMC decisions can trigger FOMO or FUD, depending on the narrative circulating. For example, if the market perceives the Fed as starting to befriend risky assets, traders will immediately ramp up. But if Powell signals it's not time yet, we could see a mini correction or even panic selling within hours. And since crypto operates 24/7 without breaks, reactions are often faster than in the stock market. The crypto market doesn't wait for the US market to open. It doesn't need sleep. So if you're not mentally prepared and don't have a strategy, You might get stuck before you even have time for a cup of coffee. Preliminary conclusion. The FOMC is the heartbeat of the global financial system. And while crypto is often touted as free from traditional systems, in reality, it remains heavily dependent on liquidity flows controlled by the Fed. So if you're serious about crypto, you need to learn to read FOMC signals. Because this isn't just economic news, it's a weather forecast for the market's next direction. Chapter 3. Latest FOMC decision results. What impact will this have on us? On Wednesday evening Washington time, June 18, 2025, the Federal Reserve finally announced the much-anticipated results of the FOMC decision, eagerly awaited by global market participants, including crypto investors. And the outcome? As many analysts had anticipated, the Fed decided to keep the benchmark interest rate within the range of 4.25% to 4.50%. This marks the fourth consecutive time the Fed has maintained this interest rate level since December of last year. Why did the Fed hold interest rates steady? The primary reasons are quite complex, but they can be simplified into three key factors. 1. Unstable global conditions. The resurgence of trade wars and geopolitical tensions in the Middle East have prompted the Fed to adopt a cautious approach. They do not want to risk lowering interest rates too quickly. 2. Inflation is starting to stabilize, but not yet under control. While core inflation is beginning to ease, pressure on the prices of essential goods remains. On the other hand, the unemployment rate has increased, which prevents the Fed from being too aggressive in cutting interest rates. 3. Political criticism and pressure from the White House. President Donald Trump has openly criticized Fed Chair Jerome Powell for refusing to cut interest rates. However, the Fed has maintained its independence and ignored political pressure. How did the market react? The market has reacted to this decision with relative calm. In fact, the crypto market capitalization has risen slightly by approximately 0.35% over the past 24 hours. Bitcoin, BTC, remains stable around $104,000, up 0.28%. Ethereum, ETH, has also strengthened to $2,499, up 0.86%. XRP and SOL remained flat to slightly down, indicating the market is not yet fully confident about the next direction. This movement suggests that market participants had already anticipated the Fed's decision. There were no major surprises, but also no significant triggers for a rally. In other words, the market remains in wait-and-see mode. Will there be a rate cut this year? This is interesting. In his press conference, Jerome Powell stated that the Fed remains open to the possibility of cutting interest rates, but this is highly dependent on future economic data. The latest projections suggest a possibility of 1 to 2 rate cuts in the second half of 2025, but there are no guarantees. In other words, the Fed is signaling easing, but not yet. They still want to see concrete evidence that inflation is truly under control and economic growth is not being disrupted. What does this mean for crypto investors? For us in the crypto world, this decision implies two important things. 1. Temporary stability is an opportunity. Liquidity hasn't been increased, but it hasn't been reduced either. This means the market can remain sideways, but isn't threatened by a major sell-off. 2. Be cautious with major economic data releases, since the Fed will heavily rely on future data. Reports like CPI, PCE, and labor market data could trigger significant volatility. So, this FOMC meeting didn't cause the market to explode, but it provided an important clue. Easing may be coming, but patience is key. And in crypto, sometimes patience can be an edge for those of us who know how to leverage this pause with smart strategies. Chapter 4. Strategies for Surviving and Profiting Amid Market Uncertainty. Following the FOMC's decision to keep interest rates at high levels, many investors and traders began to wonder, so, what should we do now? This is an important question, and the answer is not simple. But don't worry. In this chapter, we will discuss realistic, sensible strategies that still open up profit opportunities, even though the market is currently in a waiting phase. 1. Focus on risk management. In situations like this, survival is the top priority. The crypto market is highly sensitive to changes in macro sentiment. Therefore, make sure you don't use hot money. You have an exit plan before entering a position. And most importantly, your capital allocation remains rational. Don't FOMO into small altcoins just because of a green candle last night. 2. Strengthen your position in core assets. Bitcoin and Ethereum remain the anchors of stability in crypto. As the Fed holds interest rates steady, this provides time and space for large investors to reposition their portfolios. If you're playing the medium to long term, this is the time for gradual accumulation, not all in. Remember, as long as the Fed hasn't cut interest rates, significant liquidity hasn't truly entered the market yet. So don't expect the market to rally wildly in the near term. But precisely because of that, current prices could be a hidden discount. 3. Stay cash, ready to buy the dip. Cash is king, especially when the market lacks a clear direction. Having stablecoins ready to deploy is like having ammunition while everyone else is debating the market's direction. Set price alerts and wait for opportunities. In a sideways market, we win not by trading constantly, but by patiently waiting for the right moment. 4. Follow the economic calendar. After the FOMC meeting, the market will react to subsequent economic data releases. CPI, Consumer Price Index. PCE, Personal Consumption Expenditure. Non-farm payrolls, NFP. Each release can alter market expectations regarding interest rate direction. So, keep an eye on the schedule and market reactions. 5. Educate and evaluate your portfolio. Use this quiet period to review your portfolio. Does it still align with your risk profile? Do the projects you hold still have strong fundamentals? Are there any coins that are just following the hype? If so, this is the right time for rebalancing. Move to more promising assets or hold them in stablecoins while waiting for a clearer opportunity. 6. Build a gradual entry strategy. Don't enter the market with the mindset of enter once and make a profit immediately. Use a DCA, dollar cost averaging, strategy, or a gradual entry based on technical support levels. For example, enter 25% now. Enter 25% if there's a correction to the next support level. Hold the rest for extreme conditions. This strategy keeps you calm and prevents panic when the market fluctuates. So, the bottom line, the Fed's decision does indicate that there are no major changes in global liquidity, but that doesn't mean there are no opportunities. In the crypto world, it's often during quiet periods like this that whales accumulate their holdings. If we can remain disciplined, patient, and have a plan, this calm period can lay the foundation for significant profits when the next bull market arrives. Stay calm, stay sharp, and don't forget, those who endure the longest usually reap the most rewards. It's time to play smart, not recklessly. Crypto friends, we've covered a lot today. From in-depth explanations about the FOMC, its ripple effects on global markets and crypto, to concrete steps you can take to stay sane and keep making profits. The Fed's decision to keep interest rates at 4.25% to 4.50% wasn't a huge surprise, but its impact is still felt. The market is in a slow burn phase, not bullish, but not crashing either. In situations like this, what's needed isn't extraordinary courage, but calmness, patience, and strategy. And don't forget, every Fed move is like a compass for the global market. If you understand the direction of the wind, you can set your ship's sails more accurately. Don't just be a passenger. Be the captain of your own portfolio. The market doesn't reward speed, but precision. So, if you feel FOMO or panic because others are making money first, take a deep breath. In crypto, those who are patient can buy at the bottom and sell at the top. And most importantly, crypto isn't a getaway. It's not a shortcut to wealth. It's a place for those who want to learn, be disciplined, and understand risks. If you're ready with the right mindset, the market will reward your efforts. Disclaimer: all information in this podcast is provided for educational purposes only, not as investment advice or recommendations. Crypto is a highly volatile asset. Always align your investment decisions with your risk profile and conduct thorough research, DYR, before making any decisions. 5 Principles of Mr. Suw Crypto, today's version. 1. Hot money is for the kitchen, not for opening positions. 2. Over-leveraged? Better to oversleep. 3. Stay strong at 70% Bitcoin, 30% altcoin. 4. Holding cash isn't about fear, but being ready to buy the dip. 5. Those who think long-term usually last longer and see more tangible returns. If you found this episode helpful, don't be stingy. Click like, subscribe, and share with your like-minded friends. And if you have your own thoughts on the FOMC or strategies in the current market conditions, let's chat in the comments section. Healthy discussion equals shared profits. See you in the next episode. Warm regards, and keep profiting from Mr. Suw Crypto.